where
Mm-hmm.
we
Mm-hmm.
might have stress tested bad debt from 3% to 7%. Well, now we stress it to 20% for X period of time just to see what that looks like.
Hello, listeners. Welcome to Ritter on Real Estate. I've got a very special guest today. I've got Aaron Ross. He's the VP Investments at Birge and Held Asset Management, and he's here to continue our COVID-19 series, where we've heard from a couple of other individuals on different aspects of multifamily. And Aaron's going to talk to us today about how it's affected their acquisitions, their underwriting, and even their dispositions of a couple deals that they've got for sale. So I think it'll be a really interesting conversation to hear the impact from his perspective. So thanks, Aaron. Appreciate you being here today. Why don't you go ahead and give the listeners just a little overview on your role, a little more into what you do on a day-to-day basis.
Yeah, thanks for having me, Kent. It's great to be here. And as you mentioned, work in the investments group at Birge and Held and run our market rate acquisition disposition teams, where I oversee anything that we're doing across the central U.S. in terms of multifamily market rate acquisitions. That's the only retail or real estate sector that Birge and Held is involved with. We primarily focus on suburban workforce housing across the central U.S., call it from Atlanta to Denver. Don't focus on the coast. Over the last few years, we've completed 6 to 7 thousand units of on the acquisition side and have disposed of about 1,500 units. So, been a part of about 30 transactions over the last 3 years, and it's been an awesome time to grow in the multifamily real estate world. And COVID-19 is something that we haven't seen in the last few years and ever before. So, um, it has definitely changed how we have looked at deals and has changed the current landscape of the deals that we have under contract right now on both the buy and sell side.
Yeah, I'm sure, and I didn't realize that's a ton of volume. So I'm excited to. Yeah, I mean, obviously, you guys are well versed in this process, so I'm interested to hear your perspective. So let's start off with just understanding, how has the current environment changed your acquisition approach? I mean, are you guys still actively acquiring? And if you are, I mean, how has that changed for you?
Yeah, we are still actively combing through opportunities. I think as every um, capital markets firm has done over the last 10 to 14 days, as we start to see the stay in place orders by governors in different states that we work in. Those have really tempered our volume expectation in the short term. For us, we're under contract on a handful of deals. We're working actively to structure increased due diligence timeframes due to these stay in place orders. Our teams can't get on site, our teams can't travel to different states, and it's caused some difficult logistic decisions. What we've been asking for, which I think what a lot of buyers have been asking for, is more time. Let's get out of this current state of emergency that most of the nation is in, and so that we don't end our due diligence period under coronavirus stay in place. That wouldn't that wouldn't allow us to do all of the work we need on the due diligence front. Uh, a lot of sellers, most sellers, are working with us to get those extensions in place that would be required for us to complete that due diligence. On the sales side, we're working with our buyers, understanding that most lenders are requiring a different look on the acquisitions of assets, whether Fannie Freddie on the debt service obligations, in those reserves, which are new. Uh, if there's buyers working with debt funds, a lot of debt funds have gone away over the last just few weeks. And so, what most people want and what we want is time. It's time to figure out uh,
Hmm.
what do April collections look like. And so, ending the due diligence period before you have a clear understanding of what April collections look like puts your investors and puts yourself in a bad position. And so, we're trying to avoid doing that.
Hmm. Yeah, I think you made a couple good points I'd like to hear a little bit more on. One is just on April collections. I mean, obviously we expect, I would assume that they're going to be down, right? I mean, we
Yeah.
heard today in the jobs report about 3.2 million people applied for unemployment this week. So pretty
Mhm.
incredible. It's about a 1% of the population,
Yeah.
U.S. And so as we so thinking about that, so how does that change? How does that change your forecast for how a deal performs? I mean, is it a blip on the radar, or does it fundamentally change how you expect the outcome of that deal to perform?
I think, yeah, overall, I think it's a blip on the radar for a 5 to 7 year hold period. However, it completely changes the way that you stress test an underwriting model. So
Hmm.
I think there's a lot of stuff you can do in an underwriting model to prevent this COVID-19 crisis from having long-term ramifications for the returns to investors. I think one of them is being a putting a reserve in place on the equity side for any collections blip that you might have over 90
Hmm.
days to 12 months. So if you thought your terminal bad debt was 2 to 3%, you stress test the model to say, what if bad debt was 15% for X number of months? Figure out what that difference is between your terminal bad debt and your short term blip due to COVID, and capitalize that as part of your equity. So if you have a $10
Mm-hmm.
million equity check, maybe all of a sudden it becomes 10.5 million. And so that because of the $500,000 of carry that you would need, and that's how you can protect that going in yield and make sure that you have a um, the the clearest picture on what the year one yield would look like from a delinquency
Hmm.
standpoint, and that way you can protect yourself from um, the crisis affecting long term returns. I think the answer to your question, not only just on delinquency, but what we're doing is making sure that our deals are capitalized correctly, and they are even more capitalized than what we would do previously, so that you have minimal disruption over the first year of a hold, and
Hmm.
so capitalizing delinquency dollars, stress testing to see where your break even points are in occupancy. Um, all of these are different scenarios that we typically run in our standard underwriting model, where maybe we've just changed the outward bounds of year one, where
Hmm.
we
Hmm.
might have stress tested bad debt from 3% to 7%. Well, now we stress it to 20% for X period of time just to see what that looks like.
Right.
But we don't expect that to be a long term. Even in the last few days, we've seen a lot of movement from the government with the stimulus package, where um,
Hmm.
we think that the overall ramifications of COVID will be short term. Now, um, on the other side of that is, how do you stress test the out sale of your asset, your purchase? So maybe you were doing a 20 basis point uh, expansion and cap rate per year, and then you stress test it to 50 basis points for a
Hmm.
few years. I think the name of the game for us is to capitalize the assets with more cash up front, and then stress test what that out sale looks like, knowing that we're structuring our debt and equity that we never have to sell in the middle of a COVID-19 crisis if it were to come back again. right? So
Hmm.
uh,
Hmm.
right now, I wouldn't suggest doing a 1 year bridge loan and doing a rehab plan because you might miss all of your rehab bump targets and you might have a loan coming due when the economy hasn't rebounded fully.
Yeah.
So there's a
Yeah.
lot of different protections you can go through, but being prudent on timing risk and the upfront cash that you call are probably the two best ways to mitigate any short-term blips.
Oh, that's great. No, those are great tips. And yeah, to dig into that a little bit more. So and I guess just to clarify some of those things you said to make sure that I'm understanding correctly. So it sounds like you talk about, overcapitalizing or raising more. We're talking about um, in the balance between returns and stability, talking about shifting, raising more money, which is going to lower overall returns, but it's going to make the deal overall more stable, right? You're going to be able to
Hmm.
to move through those up and down. So what you're seeing or talking about is shifting that pendulum a little bit from returns to stability. And it sounds like something
Hmm.
that you guys have already been on the more conservative side, but even more a shift in that direction. Is that what you're thinking? And is that something that you think that investors coming out of this are going to be looking for versus just talking about an IRR, a cash on cash return, for example? Do you think that
Yeah.
that search for stability?
Yeah, absolutely. And I think um, when you're stress testing a model and you are looking to raise more funds and understanding how you want to capitalize the deal, let's say that in that example I gave where you're raising $500,000 more of equity, when you start to run the cash on cash returns and IRRs for those investors, you're really going to see a minimal impact to the overall return to an individual investor. It might be 20 to 40, 60 basis points on a
Mhm.
5 to 7 year look. And so that's really a minimal impact over the life of a hold as compared to if you try to dot the I on the capitalization of equity going in, and all of a sudden you miss it and you're having a capital call in 12 months.
Yeah.
The risk offset of a capital call versus 20 to 60 basis point net return to investors are pretty far apart.
Mhm.
And I
Mhm.
think to your point, you're exactly right. You'll start to see investors that are more focused on not just the number, not just the pref rate for an investor, not just the IRR net to investor, but the assurance of and the confidence that they have in those
Right.
numbers. And I think what you're seeing on Fannie and Freddie, what they're doing with forbearance, we think HUD will follow, and what you're seeing on just even the government agencies outside of the lending institutions focused on maintaining stability for housing across the US and many different
Mhm.
jurisdictions, I think you'll see a lot of investors flood to multifamily because those lenders that are creating and maintaining liquidity inside the multifamily space, that doesn't exist for other real estate sectors. And so what I think you start to see is a lot of investors flooding back to multifamily because of that assurance of return that they'll see based on the liquidity that's provided in the
Yeah.
multifamily sector.
No, that's really interesting. So breaking it down for our investors, I mean, it sounds like the questions that we need to be asking are how are you stress testing these deals and not just getting the oh yeah, we stress test, we raise bad debt, we look at occupancy, but really understanding what are the bounds that you're using, right? Because you said, historically you may have gone up to 5% and saying, wow, from 2 to 5%, that's a huge move, right? But now you're
Hmm.
saying, even looking at what does 20% mean for a number of
Right.
months, right? So really expanding what those bounds look like and how making sure that even in the worst, I mean, nobody ever expected this would happen, right? But it's happened. It's a reality now, and we need to prepare for it
Hmm.
in the future. So I think investors need to be asking how are deals being stress tested, and even what are the bounds that they're stress testing to. So when you do stress test, I know we talked about bad debt as one example, and I guess that moves with occupancy and things as well. But what are the, I guess, what are the measures or the ratios that you're using to stress test? What, I guess, what are the variables that you're using when you stress test?
Sure. So we talked about bad debt, and you brought up a great point where then that really buoys with occupancy. So you look at that overall spread between, call it your physical occupancy and your economic occupancy, which is
Mm-hmm.
made up of concessions, bad debt, and other rental losses. And then another thing that you stress test, I mean, what's your going in business plan? Is your going in business plan to replace countertops and flooring and appliances and getting a $100 rent bump? Well, what if all
Mm-hmm.
of a sudden you get a $0 rent bump on those rehab plans? What if you don't get a rent bump for the first 6 months? So, and that also relates to what we just talked about, the cash that you raise. Maybe you're
Mm-hmm.
raising less cash because you're doing a smaller rehab project and getting a lower rent bump, but you're also raising funds for a delinquency capital reserve. And so
Mm-hmm.
all net, you're raising about the same funds, but you're getting a lower rent bump because you're doing a lower rehab project because now all of a sudden and uh, the rents are too high and there's rent pressure. And so that's what we're stress testing rents a lot in, call it, the first 2 years of a model, to where what is our rehab plan currently, and that rent bump, what do we think the rent bump might go
Mm-hmm.
down to? But then also, what's your terminal rent growth assumption? As I sit here in Indianapolis, the rents over the last 20 years have grown, call it 2.5%. And now rents might be flat for the next 6 months, 12 months, 24 months. And so, what does that do to your year 1 through 3 cash on cash yield to investors if all of a sudden you get $0 rent bumps or you get negative rent bumps to maintain the occupancy that you're underwriting? So you have to think of, and there's no right answer. I mean, what the answer is, you run multiple scenarios to stress test the different variables
Mm-hmm.
together. And so that's what we have, a whole page in our underwriting model of just stress test scenarios on what's the average cash on cash return look like when you stress test occupancy, bad debt, rent bumps, terminal rent growth, and where does it start to break the model?
Mm-hmm. Yeah. So that, I mean, that's great. That sounds very sophisticated. I mean, I appreciate you sharing the different metrics. And so I think, yeah, going back to that. So those are the questions that we need to be asking as investors. Are we stress testing? In all those different scenarios, and what's the impact? And are we? I mean, I thought you brought up something that was interesting, was because if you think about it from really a risk adjusted return, right? You talked
Hmm.
about, a lot of these deals can look fantastic. You say, oh, it's going to be 20%, average annual return. That's great. But you go back to, what's the likelihood of that occurring, right? And I think when you're talking
Hmm.
about doing, you know, going for smaller rent bumps, doing less of an intense rehab, but also having to raise less money, you know,
Right.
you're you're looking at overall a less risky project, right? So when you look at it from a risk-adjusted return standpoint, that project may nowadays actually look more attractive than something that's touting, a high double-digit return, or something in the high teens or low 20s that maybe even a month ago, people were looking for. So I think looking at it from a risk adjusted return standpoint is going to be really important for folks. We always need to make sure we're considering risk, not just return, when we look at our deals. So
Yeah,
from
absolutely.
Um, and something else you brought up was just kind of what's happening from a debt standpoint. You mentioned the forbearance. I know from a CMBS standpoint, things have kind of frozen at this point, kind of locked up. But I know that in other areas, it sounds like banks and even bridge lenders are trying to work with folks and getting a little more room to work, I guess, than they would have, like, in 2008, for example. Can you talk a little
Yeah.
bit about maybe the agencies, what we're seeing with banks, the different markets and different lending sources, what we're seeing, and how that does contrast with what we've seen before? Because something I've been talking about with people is like this is not 2008. It's very different, right?
Hmm.
And I think credit's acting differently. So I think any light you can shed on that would be great to hear.
Yeah, I think that's a good point. I think what we're seeing a lot, and I think a lot of folks have spent a lot of time on phone calls with some of the national firms to and see what they're saying. And you mentioned Fannie and Freddie, um, the forbearance program, where um, what does that look like if you can defer your debt payments for up to 12 months? Then you start to look at a deal by deal basis. Is that something that you want to take on? So,
Mhm.
then you're talking about like debt funds. We've seen a lot of debt funds go away for the time being. Their lending, their sources of funds have paused to understand what the market is, um, and banks. It's all depending on the balance sheet of the individual bank, but I think in general, everyone is tempering their expectations from Fannie, Bridge,
Mhm.
banks, and everybody's and they're putting a pause in the market to understand um, what is what is the risk in the market from a collection standpoint, and then also as they go to securitize those loans in the marketplace, how deep is the buyer pool for those securities? And so what we've seen is a huge increase in spreads for both Fannie Mae, Freddie Mac over the last week or so. At first, it was because the Treasury had fallen off a cliff, and they had taken on so much volume. I think like
Mhm.
Fannie had done 10 billion in a week, where they were supposed to do 100 billion over 15 months, and so they started to temper the volume with increased spreads. And then as they go out to the market, and they have a smaller buyer pool of those underlying securities, the bonds, the spreads have gone out because there's less demand for that security. And so
Mhm.
all of a sudden, where we thought we were going to have this awesome long-term debt at sub 3%, well, the market has spoken, right? And the market has made it more difficult for them to get the loans off their balance sheet, which has increased the spreads by the lenders. And so net for people that are taking on debt, the world is really hasn't changed a whole lot, and it's only changed. Interest rates are still extremely low from a historic perspective, but the lenders have tempered their expectations, and maybe all the goodies they're willing to give in terms of interest only, in terms of now they're requiring reserves that we spoke about earlier, debt expense reserves, replacement reserves
Mhm.
for Fannie Freddie that weren't usually in there, and so um, all of that to be said, keeping your relationships with your lenders tight and knowing who you're working with, and doing deals with folks that you've done deals with before becomes extremely important, and because not everybody has the capability of making loans right now. Fannie and Freddie have
Mhm.
leaned
Mhm.
in over the last month to help support other lenders that have gone away in terms of the debt funds and other lending sources.
Do you think there'll be, because I know coming out of, from 2008 to now, I know Fannie and Freddie went from being a fairly small percentage of the overall debt to being almost, or maybe more than 50% of kind of the overall, if you look at multifamily debt and where people
Hmm.
are getting their debt from. Do you see that continue? You think it's going to continue to even increase now because of this?
Yeah, absolutely. The stability of Fannie and Freddie, as of right now, no, uh, I think will continue, and I think we'll see them continue to pick up market share. Just in our shop alone, we've switched to Fannie Freddie over the last 36 months as they've become more aggressive in terms
Mhm.
of their interest only period, in terms of their ability and to underwrite value add rehab deals. We used to be primarily a HUD lending shop, and also the ability for lenders to take on 75% leverage or so with non recourse is a big deal.
Mhm. Mhm.
Specifically, from the sponsor side, as you navigate the choppiness and the um, of the market, recourse becomes a big item to think about when you're doing loans. Is that
Mhm.
specific we were talking about earlier with uh, doing a bridge loan for 12 months that would likely carry recourse because you were going to execute on a rehab program. Well, for all of the reasons we just talked about, the ability to get off a recourse loan might become more difficult if the economy's bad for the next 6 months and you can't execute a rehab program. And then you have a sizing issue and might need to stay on a recourse loan longer than you would like. And so,
Mhm.
for all of those reasons, I think Fannie and Freddie continue to gain market share, and it'll be interesting to see their capacity requirements and what they're able to do at the end of 2020 because it's not as if Fannie and Freddie, the future of those are 100% clear.
Gotcha. Right, right. No, that's really interesting. So, one thing that you brought up earlier in the conversation was just as we start to think about, we're in the environment right now, the flight to security, and you mentioned that multifamily is expected to do, fairly well in this space, and some of that is because of the debt dynamics, but some of it is, I think, related to just other things that are going on. Could you talk a little bit? Can you expand on that a little bit on why you think, and I mean, I agree with you, but why we think that multifamily remains a good asset class to be in, and is probably going to continue to outperform some of the others as we go through this and then come out of the current pandemic?
Yeah, I think the main reason, not to oversimplify it, would be that you need a place to live. Having a place to live is a need versus having a place to go work is not necessarily a want. You need to do that, but
Mhm.
as you and I
Everybody
both
works from home
sit
now anyway, right?
exactly right, exactly. I was just gonna say, as you and I both sit here doing this podcast, both from our home.
Yeah.
We live here. We need a place to live. We don't necessarily have to. I know our firm has been working from home for 2 weeks, and we expect that to continue for at least another 2 weeks. And
Mhm.
so, does what does the demand for office space in the U.S. look like post COVID-19? That's certainly not a
Mhm.
question I have an answer to, but it's
That's
certainly a
interesting,
hard,
yeah.
yeah. And industrial is will be another great place to put your money. I mean, as you look at how many people Amazon's looking to hire, you have Walmart hiring, and a lot of that
Mhm. Mhm.
fulfillment centers that are growing in employment. And the in Indiana right now, you can only get food from delivery, and so having on-demand services, well, all of those on-demand services still go to your house. And so I think ultimately what you see is pressures in office, pressures in retail, but everyone still
Yep.
needs a place. And what we like about our portfolio is we're primarily workforce housing, either capital A or lowercase a affordable. And being in that fat part of the demographic curve where most of our assets are workforce housing in Midwestern secondary and tertiary markets, where the average rent is $850 a month. We sit here and look at a stimulus bill where 98 or 99% of our residents will qualify for the stimulus bill, where the check they will receive will be more than what their monthly rent is. Now, it remains to be seen if they use all of that for their rent, and that's a whole different conversation. However, as we sit here knowing that the support they will likely get from the government is more than the 1 month's rent payment, it makes us feel good about a landlord, that
Mhm.
they will have coverage, because um, everybody has a different living situation. Most of our renters were likely living paycheck to paycheck, and this has been a huge disruption for them. And so I know on the operations side, our team has done a lot of work to make sure they're working with the individuals and making payment plans and whatnot. But um, all of the intervention that you see from the government, from lenders, is unlike anything that you see in any other real estate sector. And so
Mhm.
that is why I believe, and try not to be biased given what we do, but that multifamily, the demand for that real estate will far exceed other sectors. Maybe only industrial being paired with that.
Mhm. Yeah, no, I think that's great, and you said at the end or at the beginning not to oversimplify, but at the end of the day, the fundamentals haven't changed, right?
Hmm.
I mean, there's still a massive discrepancy between the amount of supply and the amount of demand for housing, and that's not going away, right?
Yep.
I mean, if anything, housing starts have slowed down again. So I think as we get through this and things start to normalize, I think you got to. To me, I try to keep it simple and go back to supply and demand, and I don't think those dynamics have changed. So I do think long term, it's interesting you brought up the Midwest though, because I am interested. You know, regionally, I know you guys have been primarily focused in the Midwest, but I know you have properties in the West and in the South as well. Do you feel that the Midwest will outperform longer term, just based on the value there? And I know one thing that you guys look at, I believe, is kind of looking at the income to rent ratio, right? And how
Hmm.
that varies in the Midwest versus other parts in the country. Maybe you can comment on that a little bit.
Yeah, I think whether the Midwest outperforms other regions is something that I've looked at, and one of the biggest knocks on the Midwest would be just overall velocity in the market, and just a volume of dollars that will always go to the coast,
Hmm.
outside, and so that we'll just take that off the table, as that always will push cap rates down for coastal markets and gateway cities. But to your point
Sure.
on the affordability, I completely agree. I think our portfolio sits about 19 or 20% rent to income. And so, according to HUD's affordability standards, someone becomes rent burdened at 30%. And so we have a significant runway between what our current portfolio sits at and then that burdening factor, according to HUD. And so, I think what happens is the Midwest can outperform because it still offers an increased opportunity for yield in the marketplace. Where historically, I mentioned Indianapolis is maybe 2.5, 3% rent growth. It's been a little bit
Hmm.
higher recently, where um, as a compared to the coast, you underwrite and how you can pay a four cap in a gateway city market, or even a three cap pre-COVID, would be that you get 6 to 8% rent growth every year, and that was typical in good times in gateway cities. However, you see a contraction all the way to zero for a short period of time. That's a much
Hmm.
wider gap to get back to 8% rent growth. Whereas in the Midwest, if you're at 2.5,
Right.
3%, and so you start to see the stability of that market, and in the Midwest. And so I think it will outperform, and it'll afford more opportunities for rehab projects, uh, and the because of the rent burning factor, and overall
Hmm.
rents are cheaper. And so I think it will outperform in those ways. It's overall, I think a lot of capital shies away from secondary and tertiary markets because of the question:
Sure.
how do they get out of the market? Just because of the
Right.
lower velocity of dollars going to those secondary and tertiary markets.
Oh, gotcha. That's good perspective. I didn't think about that, but I guess that's. I mean, it's a good point in that. So, from one aspect, there's a lot of positives from Midwest, but just from the, people actually may may shy away now based on kind of going back and wanting more of that security. I mean, the money may stay more with the coasts of just, as you said, the velocity there, the ability to get in and out of deals. So who knows how it's going to end up, but I think it's a
Sure.
good discussion. I mean, I just think about some of the markets that have been hottest lately, like Las Vegas and Orlando, for example, that are their employment base is so heavily weighted in hospitality that I feel like those markets have to be hit hard. And those are both markets that have been growing like crazy, right? 5+% rent growth for a number of years. And I know a lot of active construction going on as well. So I wonder if those markets, get hit harder, and then at some point in the future, there's a buying opportunity again because of, somebody gets left
I
holding the
think
bag.
Yeah, I think that's a great point. I didn't think about that in terms of just those two markets in particular. And so if you take the regions off the table, which I think that, I mean, you just brought up a great point. Look at markets that have the hospitality sectors, just specifically Orlando, Las Vegas, whereas maybe not regionally, just Midwest. Something that we focus on would be whether it be a state capital, whether it's a financial capital or a healthcare
Hmm.
capital
Hmm.
of a region or a state in particular, to where an education capital based on major universities, to where
Hmm.
healthcare, government, education being much more resilient, not only just the COVID-19 crisis, but
Hmm.
most all
Hmm.
crisis, that those jobs might not be as high paying as other industry jobs, but they usually they recover from recession and they're more stable inside of recession. And so I think you bring up a great point where if you bought a deal in Orlando at a sub five cap, or Las Vegas at a sub five cap in the last 12 or 24
Yeah.
months, and then expecting 5 to 6% rent growth, and then even more so if you're rehabbing a deal, um, you're probably looking at a much longer hold period than what you originally contemplated, because you'll have
Right.
significant
Right.
pressure.
So hopefully the folks that have been doing that, because a lot of people are taking on long-term debt, right?
Yeah,
10-year debt.
right.
So they've got the time to make that deal work. Otherwise, there will be folks that are in trouble, unfortunately.
Hmm.
No, it's really interesting to think about. So takeaway for the investors, I'd say, is as you're looking at deals, understanding the job diversity in the market and looking for jobs that are not cyclical, right? Like you said, healthcare, education, and government. Those are things that are going to be pretty solid, relatively solid through all the economic swings, right? So I think it's a great takeaway.
Yeah.
Well, the last question I wanted to ask Aaron was, obviously nobody expected a shock like this, but in everything there's lessons learned that we can take away. So, what's your one big thing that you've already learned so far that you're going to implement into the future as you guys go continue to acquire deals?
Yeah, that's a great question. I think you gave me my answer on your response to the last question, because I think it's exactly right. I think the answer is time, uh, time and flexibility of an investment horizon. So you made the point of locking up long-term debt, to where, given any
Hmm.
economic cycle, if you have 10-year debt, you would expect um, that the economy would come back, and pricing would stabilize in a 10-year period. So I think for us, and then what we talked about at the first part of the call was uh, needing time on deals that we're under contract on, both buy and sell. Needing time for more due diligence, needing time for more closing period, as buyers or sellers have to navigate a different capital markets environment. And so I think the biggest lesson is having time and having flexibility in deals is invaluable. There's no um, there's really no replacement for that time factor. You need
Hmm.
to have the flexibility where, regardless of what the economy is, you always have the option to hold. The people that are going to lose money because of COVID-19 are likely losing money because they're in a forced capital event um, transaction.
Sure.
If you have the
Sure.
ability, yeah, if you have the ability to hold and stabilize through COVID-19 and you can sell an asset in 2021, I think most people are making that plan rather than trying to sell something, call it May 31st or June 30th, after probably the choppiest collection period that they've
Right.
ever
Right.
had. And so I think you gave me my answer is the biggest takeaway is just always have time.
Hmm. Hmm. No, I think that's great. I appreciate that. And so it sounds like you guys are going to be looking at, what are those long-term debt structures as you're underwriting those deals. I think that makes a ton of sense. Well, thanks, Aaron. I appreciate your time. A ton of value, I think, and some things to think about. Some great takeaways for the investors. If you guys want to learn more about Birge and Held, it's www.birgeandheld.com. I'll include that in the show notes, so I don't have to spell it for you, and you guys can check them out. But obviously, you're hearing from the man that's running their underwriting and their acquisitions, and he knows a lot. So I think you'll be in good hands. But thanks a lot, Aaron. I really appreciate it, and I hope to have you back.
Awesome. Thank you, Kent, anytime. And thanks for putting this together.